Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM. Today's Friday, it's the 10th of March, and I just want to point out my email address, rshaw@fxcm.com. And of course, if you need to get hold of me, that's the email to use. Just going to go ahead and bring up our high risk investment warning. Can I confirm that everybody can see me, hear me, and see the screen? Okay, excellent. Thanks, Shadrach. All right, we're going to have a live trade today for the non-farm payroll. I've just put the link in the chat. Please register and join if that's something you'd like to join us for. Here is our market commentaries disclaimer. I'll just keep this on screen for a few moments. Thanks, Anna. Morning to you. Nice to have you on the webinar. All right, and our references, Market Scope and Trading View. Let's just go through to Market Scope first. Let's take a look at the DAX. And this is the daily chart of the DAX, and it's going back to the beginning of February. So this is the 2nd of February. And it's been very hard to make money since the 2nd of February. And the reason that it's been very hard to make money is because it's been moving sideways. It's much harder to make, hey Indran, morning to you. It's much harder to make money in a sideways market than in a trending market. The trend's your friend, right? So it's very difficult at the moment, the market conditions, and you can see that the current candles actually gapped down. You see there's this gap down, so there's some negative sentiment as we move into non-farm payroll Friday. And we're sitting really right in the middle of no man's land. And what's effectively happened overnight, I just want to bring up the FXCM banks basket. We'll just have a quick look at the banks basket. And let me go through to the weekly chart here. And you can see there's this massive, this is about almost 10%. This is almost 10% down. It's almost 10% down. And the idea here is, let me just take a look at this on the daily. Yeah, so you can see that it's really the banks baskets come down. What happened was there was a news item that came out with regards to a company called SVB, I beg your pardon, SVB Financial Group. They're the holding company of Silicon Valley Bank, and they announced that they are going to have to come to market for an equity, common shares and preference shares. They're going to have to offer some shares to get some capital. They're also looking to sell assets to cover a $1.8 billion loss. And that's really rattled the market. And effectively what's happened is the markets are looking at all the banks now and are scrutinizing what kind of exposure banks have to these type of losses. Now, what happened with Silicon Valley Bank? The majority of their clients are venture capital clients, and the venture capital industry has been, according to SVB, burning cash. And because they've been burning cash, they've got high liquidity needs. So they've been withdrawing the money. So SVB can't hold on to the deposits. So they can't hold on to the deposits. And well, the question then is, number one, what kind of worth are the assets if you're forced to sell? And number two, how do you actually retain your deposits? And effectively what's happening here, I just want to show you, is that I think you guys all realize how sort of banks work. You've got interest rates that they'll pay on deposits and interest rates they will charge on loans. And clearly, the interest rates that they charge on loans are going to be much higher than the interest rates that they pay on deposits. And the difference here is what we call the interest rate margin, okay? And the steeper this is, the more positive the interest rate margin, the more money the bank is making. Well, if you want to retain your deposits, you're going to have to pay these guys more. You have to pay these guys more. So that's going to have to drift up. Well, if it's going to drift up, let's make this next thing red. You're going to get something like that, or like that. It's becoming shallow. It's eating into your net margins. So that's what's kind of worrying the. Hey, Howard, morning to you. Nice to have you on the webinar as always. So as you can see, the markets now are worried about the banks, because effectively what they've been doing is they've gone into the banks. You can see the banks have got this higher trough, higher peak. There's an uptrend, okay? So there's this uptrend, and effectively the banks are a good place to go in a rate hiking environment because of the interest rate margin. Now there's this whole question as well. You're going to probably have to increase your deposit rates to hold on to clients. That's kind of what's and there's this fear. There's this fear that there's going to be a bank run on SVB. In other words, the venture capital guys are going to start pulling out their money en masse. So we just got to watch the story very carefully. The worst thing to happen is to get contagion within the banking sector. That's one of the quickest ways to really exacerbate a bear market. So we want to be very, very careful there. Howard's just asking for the link again. I'm just repasting the link into the chat, Howard. So go ahead there and click on that. Tell me if you don't have it, but I've just repasted it in. So you can see we've got this big drop down here. Now it remains in uptrend, until we take out the this higher trough. So we want to watch this very, very carefully. And you can see that already it's starting to affect the DAX. Okay, we go through to the DAX. Let's just go through to the daily chart on the DAX. And you can see that it's put us in no man's land. Okay, so we just got to be mindful that there's no contagion here. That it's a scary story. Now it seems that there could be this perfect storm that could be brewing, and I just want to discuss that. So we've got this SVB story. That in of itself, in my mind, I don't think the major banks would. Well, I've got to be very careful here. Stranger things have happened, but I think the risk controls at a bank are very tight, and there's stress tests, and the Fed keeps an eye on these guys, and you know, to have contagion here, I think is a stretch too far. But we've got to watch it, okay? But nevertheless, there is nervousness out in the market because of that. So the sentiment is certainly being affected. The next piece of the puzzle is going to be the non-farm payroll today. If we get a higher non-farm payroll today, then I think the markets, the floor is going to open up, because then there's going to be a real sort of panic. And then on Tuesday, we've got the CPI, and if CPI comes higher than expected, that could exacerbate things even further. So we've got the making here of a perfect storm. So we've got to watch all of these things very carefully. We've got to watch how the story evolves from SVB. We've got to see what's going to happen with the non-farm payroll. We'll do that with the live trade. I don't think we're going to get a blowout figure. I think that blowout figure is a seasonal anomaly. That's personally what I think. I think we're going to get something much closer to 200,000, subject to correction. And then, of course, we've got to see if we can get that median inflation under control. Now, the next thing that I want to show you guys, I think, is something that's I think we've got to start paying more attention to: the US dollar CAD. It's not one that we mention all that often, but I'm becoming quite interested in the US dollar Canadian. And the reason that I'm becoming interested in the US dollar Canadian is because the Bank of Canada is effectively holding their interest rate. So the Bank of Canada reported this week. they held their rates. I think it was at 4.5%, and they are anticipating that the inflation rate comes down to 3% by mid-year. And whilst they did say they prepared to increase interest rates if necessary, they are holding at the moment. The Fed, on the other hand, is being exceptionally aggressive. We know that. So if they are being exceptionally aggressive, what we can do is we can go through to the 2-year yields. The two-year notes are good proxies. They're on the short end of the yield curve. They're good proxies for central bank policy. And we look at the spread between the US 2-year and the Canadian 2-year. And what we've got here is the weekly chart. And what we can do is we can actually start putting in some peaks and troughs. So let's put in a trough over here. Okay, so we'll put in a T for a trough. Okay, let's put in a reference peak over here. Okay, now we're doing peak and trough analysis on the actual spreads between the two countries' 2-year nodes, right? And what we can see is we've got a higher trough. Okay, and once we've got the higher trough, here's the higher peak. So you can see that the spread of the 2-year notes is definitely in favor of the US. That's no surprise. The Fed is the more aggressive of the central banks. Now, because we've got the higher trough, higher peak, let's see how the US dollar Canadian is tracking. And you can see that we have a triangle here, a symmetrical triangle. Okay. And that symmetrical triangle is now completed. It's broken. It's broken to the upside. So we've got the US dollar Canadian starting to move to the upside. And you can see that the aggressiveness of the central banks, major factor here. So now we go back to market scope. Let's take a look at the daily chart. And you can see that the US dollar Canadian is in zone 1. And you can see that there's a very strong upwards momentum at the moment, very strong indeed. Okay, this movement here, this big candle here, I think that was probably on the day that the Bank of Canada came out. I think that was on Tuesday. No, it would have been Wednesday. It would have been this candle here. Okay, but you can see a very strong looking daily chart. What we've got to do now is we go back down to the hourly chart. Okay, and we got to see is, okay, how do we take advantage of this? So any sort of pullbacks to, say, the central pivot, any pullbacks to the S1 level, even a deep pullback at this stage would be very compelling indeed. So these pullback to support areas would be areas that the US dollar CAD bulls may be pulled back into the market. Why would they be pulled back into the market? Because interest rate differentials here are going to make a big difference. So all of a sudden, we are looking again at relative strength versus relative weakness. Relative strength and that weakness. That's something we haven't been able to do for a while because all the central banks have been raising rates. We've all had very hawkish central banks. Now, all of a sudden, we've got a disparity between the Bank of Canada and the Federal Reserve. And I think that's something that is worth us keeping an eye on. All right, that's what I had on my list for today. I want to just remind you guys, we're going to have a live trade today. It's going to be at 3 ZA, which is 1 UK. Please join me for that. It's going to be a very interesting non-farm payroll. If there's any questions, please go ahead and type those in now. Any questions? Please go ahead, type those in. All right, nothing coming in. So let's wrap up here, and then I'll see you guys just before the non-farm payroll comes out. Thanks very much, guys.